of the getting a pen to work, how we do balance day adjustments and how they fit into the whole our whole accounting processes that we do. Okay, so start off with, not all transactions that we complete fit in neatly into the financial year. So we've got two types of accounting. We've got cash accounting, when cash is received and we pay out, and we recognise the transaction when the cash is received, pay out. And then we've got accrual accounting. It recognises when the transaction, so when the event happens, rather than having the cash or the money cash flow occurring. So we're doing a bit more of accrual accounting. Okay, so I'm going to go, so as I said, sometimes transactions don't fit neatly into the financial year. Okay, so for example, we'll do up a little drawing here. I like to express some of these visually. So say this is our financial year. It started off at the 30th of June. Let's put a 6 there. And ends on, start that again. It's the 1st of July. It starts and ends on the 30th of June. Okay. And there's the start of the calendar year, so 1st of the January. Okay, so this is 2017, and this is 2018. Okay, so sometimes we may have to pay weekly wages and start on them. Sometimes we have telephone bills paid 3 months in advance. Sometimes we have insurance, so it might be paid over for a year, and sometimes we pay insurance, say, on the 1st of January, and it's good for 12 months. So it will extend out beyond what we've just paid, beyond the financial year, the end of it. So we need to recognise as accountants how much of it belongs in that financial year and how much of it belongs in this financial year. So then we can ascertain what a good how much of our profit belongs there, and it's more accurate. Sometimes we get examples such as telephone bills, which we'll go through in a moment. That's probably the most common one. We pay them in advance. Right? And sometimes weekly wages can be a bit tricky as well. So let's just go down to the next one. We'll go through a few examples. So we've got some categories here. We've got 4 we need to worry about. They're not really in the order that I'm going to present them in. So we've got prepaid expenses. That's the first one we'll go through. Then we'll go through accrued expenses. Then we have the unearned revenues, then accrued revenue. We'll go through to that. First one we need to worry about is the prepaid expenses. So I'm sure you have a mobile phone, and those of you who have done this before, it's called a prepaid phone plan. You might have. Okay, so that means you pay for the phone, you pay for the phone calls before you actually use them. So they are paid before we actually before we incur the costs. Okay, so beforehand, not after. We are given the assets. We call them an asset. Means that we've paid some money towards something, we haven't received the service yet. So it's kind of like an accounts receivable. I like to liken it to. We've paid for something we haven't received yet. Okay, so it's an asset. Best examples we can come up with, obviously I've said telephone. We also have magazine subscriptions. They're a good example. Okay, pretty poor magazine business if you made your customers pay after they receive the magazine. So but they make them pay beforehand, they get a 12-month subscription. Is quite common. Insurance as well is normally paid for in advance. You pay for it before you use the insurance. Okay, and very, very rarely are these transactions that they get paid on the 1st of July and end on the 30th of June. So they cross over in the financial period. So since they're expenses, we generally need to look out for them. So we're going to work on the first example. So S. Smith paid $600 for 12 months insurance. Okay, so we paid it on the 1st of January and it lasts until the 30th of June. So it's 31st of December. So let's draw a depict, and sometimes I do these up in timelines. So our job, so we've got the 1st of January, and we've got the 31st of December. And we know the end of the financial year is somewhere in between there, so it'll normally be the 30th of June is just in there. So we need to work out how much of it belongs in, of this one that paid $600. So how much of this $600 belongs in this financial year, and how much belongs in this financial year. So we know there's $600 there. We know there's 12 months in the year. So we know there's 12 months in that year. Okay, so, and we know there's 6 months until the end of the financial year. So we go January, February, March, April, May, and June equals 6. So we're going to divide that 600 up by the 6 months. So 600, and we divide that by, what was it? Divide that by the 6, and you should get to roughly a figure of about $300. So $300 belongs over here, and we'll know 300 for the other 6 months there. Okay, so we know $300 of that belongs there and that side. Okay. Okay, so we're on the 1st of January, we originally would have put $600 on the debit side. Okay, that's the normal way we do the transaction to begin with. What then? So this is how it would have looked. So $600 on the debit side. Okay. So what we need to do, we need to take $300 there. $300 of that 600. $300 there. We need to take that out of that account and place it into a little holding area we're going to call the profit and loss, the prepaid expense. So the prepaid expense account, it's an asset. So what we did to in the last video on closing entries, that revenue and expense accounts, they close off. We close those at the end of the financial year, or we do a reset of those accounts. So they need to be a 0 at the end of the financial year, because they make out our net, go towards working out a net profit or loss for the business. So these will be closed. So we need to rescue this $300 and take it out of there before it gets closed off and reset and put towards that net profit or loss for the business. Okay, so we need to take $300 there, so we don't recognise that as part of that that current financial year. So what we've done, we've debited the $300 out of the insurance account, credit I mean, and we place it in the asset here where we debit the prepaid expense account. We debit because it's an asset. So if we look up here, you see $300 has been taken out. So the new figure, I've got actually completed one here. We've got $300 is here. It's been placed in there, so it makes a new balance in this account, $300. This money is then placed over, transferred to this account, where it will sit there just in safekeeping for the next financial year, where we will, because your assets, your liabilities, and your owner's equity roll over to the next financial year. Because obviously your bank account is going to remain the same. It's not going to all of a sudden become 0 in the next financial year. Okay, then you can see what happens here. You can see a profit and loss summary. It is then transferred to the profit and loss summary. That's the remaining 300. So this is why we rescue that other bit of money out of that account before it closes. So then it'll be 0 amount in there for the next financial year, all reset and fresh to go. The next The next one is called accrued expenses. So accrued kind of means all added together and we're accumulating it. A cost incurred that has not been paid yet. The most common will be the wages. So it's going to be called a liability to us. So a liability. So liability, it means that we've probably received the service and we haven't paid it. So it's kind of like an accounts payable, if you want to think about it that way. Okay, so we just call it accrued expenses. Okay, so it's not actually an expense, it's actually a liability. And this is where it can get a bit confusing with these names. We call them accrued expenses, prepaid expenses. I mean, they're not actually those, but we'll have a little quick way to remember that when we come a bit later. So, typical example of an accrued expense is wages account has a balance of $25,000. So throughout the year, we probably paid $25,000 in wages. And on the 30th of June, we found $500 from the previous year we were still owing. We still owe $500 from the previous year. So timeline in the middle. All right, so we need to work out. This is the 30th of June. We'll say that's 1st of the 1st. Well, I like to use the calendar year, but we can use the financial year. So that's a regular year. So that's our old financial year over here and the new one over this side. So we've just found out that we haven't paid it yet because payday might fall in the new financial year, but your workers and employees have performed their work over here. Okay, so what we need to do, we found out that we've probably paid $25,000. We need to include a further $500. All right, because we found out we're not going to be paying them that until the next financial year, because the payday might fall on the 1st of the 7th. Okay. It doesn't mean that the employee is going to be waiting extra longer for their wage, because sometimes the employees, it's just the way it falls. And in most cases, you can't change the date of your payday. So if you get paid every Friday, it'll be on the same day. That's a 5. So 500 belongs on there. So we're going to add another 500 into this financial year. That hasn't been included. All right. So this is the wages account. How it will have looked. DY stands for during year. So we've got $25,000 on the debit side. We would have recorded that. What we need to do, we need to add on another 500. So we're going to need to debit this account for $500. Okay, to make it 25,500. So the wages account, as I said, will be debited. To credit the account, we're going to credit for liability. Okay, and the liability would be the accrued expense. As I said, it's a liability. So we're crediting that account. So liability account will roll over in the next financial year. The expense account will be closed off. So what will happen is we've now included this $500 here in the next financial year. So it'll be 25,500, as well as we've added this accrued expense account. So in the next financial year, when we do pay the $500, we can take this off. We can take it off in the next financial year, so it's not included in the next financial year's profit and loss. That will probably become a bit more clearer when we do reversing entries. Okay, and as you can see here, as the wages account is an expense account, it is closed off. Okay, so it will remain a zero balance. Third one that we're doing is unearned revenue. Okay, this means that we've got some income, we've received it, but we haven't earned it yet. So we've got some money from something that we've done, but we haven't actually earned it. Okay, it's normally a liability. So I don't have too many examples, but I've got a few examples. Nothing really common here. Here's some here. Rent. We received rent. Okay, so we might rent out a premises, and it was for $1,200, and for 3 months for a tenant. Okay, so I'll depict this in a timeline. So this one I'll start here, and okay, see if I can do this right. Yep, 3 months. So we've got May, June, July. Okay, end of financial year falls bang right there. So what we need to do, we've been paid $1,200 for that time, for the whole time there. We need to work out how much of it belongs in this financial year and how much in that financial year. So we've got 3 months. Simple way to do it is $1,200, divide that by 3. That should equal about $400. Okay, so it's $400 per month. So it's 400 here, belongs in this month, and we've got another 800 belongs in these 2 months. Okay, so it's 400 by 2, in case you're wondering. So we worked it out pretty quickly. So we haven't earned this amount yet. Okay, we've earned this. We've received the money and we've earned it. This one we've received the money and we haven't earned it. So we need to recognise this as a liability. We owe somebody a service. So this is what the account would have looked like. Rent revenue account. It would have been credited. Okay, there would have been a credit since it's revenue. Revenues normally have a credit nature and normally increase with a credit. So what we need to do, put it back up. So we need to include, alright, let's do that again. Yeah, so we need to recognise we've got some money in here that we may not have earned yet. Okay, so we're going to need to take away another $400, that $400 that we haven't earned yet. Okay, and then you're going to need to bring this down to the true figure, which would be probably about $800. Okay, so we've got rent revenue. What we need to do, as I said, debit the account in order to take it out. Then we need to use this liability account to hold it for a while. Okay, until the next financial year where we can deal with it there. Alright, so we now have, okay, it's the original transaction. So what we've done here, we've got grabbed this $400 and put it down here into this account. Okay, and we've left the $800, which will then go towards the net profit or loss for the business. Okay, so they do a closing entry, what we've been doing. Okay, they bring it back to reset the account. That closing entry gets it ready for the next financial year. The final one I'll show you, and after I've done these, I'll go through I'll do a few videos on some separate exercises, going through full ones, how they incorporate into the financial report, such as the balance sheet and income statement. Okay, so we have earned but not yet received. And this is what accrued revenue is. So we've earned the money, but we haven't received it yet. It's an asset. It's like, I think of it like a accounts receivable. Again, so it's an asset. Alright, so received $1,800 in interest revenue during the year. $200 has not been received. Okay, sometimes we get them like this. It's just nice and easy for us. We don't have to work out. So let's do this. Alright, so this is our financial year. Sometimes I like changing the timeline, just the depiction. So 1st of the 7th and 30th of 6th. I apologise about the pen if it's clashing with the colours. I'll deal with that a bit later. Alright, so we know during this whole financial year we've received $1,800. Okay, we've got $200 of this should be added to it. So we've got to add another $200. Okay, and it's unfortunately we're probably not going to receive it till that financial year over here. Maybe in the next day or two. Okay, it's probably just the way luck sometimes banking works. So what we need to do is try and include it in our records over here, so we can recognise it. So at the moment, remember DY stands for during year. We've got $1,800 in this account. Okay, it would have been paid to us during the year. Okay, so what we need to do, we need to add on another $200. So we're going to need to credit this account for $200 to add it on. So we need to get it up to whatever the figure will be. So $200. So I've credited the account, interest revenue. $200. This is an asset. Okay, and this is going to be debited the account. So we're going to rescue this $200. We're going to deal, as I said, we're going to deal with this since it's in an asset account. It'll roll over, and we can deal with that in the next financial year. This $200 though can be then recognised in the net profit or loss of the business. So giving us a true recognition of what it is. So this is how the account's depicted then, the final ledger account. We have $1,800 originally in this account we paid. We've added the other $200 in accrued revenues. So so it brings us up to about $2,000. So we're not going to understate our net profit for the business if we make one. Okay, and it's placed in this little holding, I call them like a holding account, these balance day adjustments. So a little holding account there for us to manage a bit later on. Now, as you can see, while we do it, we rescue it, because $2,000 now is now a rescued amount. Alright. Okay, one way to remember, okay, it's quite a common way, is our pairs are our assets. Okay, and the other ones are our liabilities. So we've got our what do we call these? Prepaid expenses, accrued revenues, and they're our assets. Okay, they're our assets, and these are our liabilities. Okay, there's nothing wrong with using slightly different variations of these if it helps you remember. So if you want to call, say if we have some accrued, let's try these ones, accrued wages, if that helps you remember, you can, but the most correct way of doing it is going accrued expenses. It just helps clear it up when it comes to writing these in the ledger. Summary of the journal entries: you're going to be debiting, when you do these, you're always going to be debiting these accounts here. Okay, again, your assets, the pairs. So if ever in doubt, just think pairs are your assets. Okay. And these ones are your liabilities. Alright. Next video will focus on doing a full exercise that has a trial balance, as well as several adjustments we need to make to the trial balance before then we'll do closing entries. And we will actually go through then and create a the full financial reports from there.